host Neeraj Shah, and the talking point today are the views on an overarching theme of the markets and specific pockets from Abhay Agarwal of Piper Serica. We are having him for the second time this year, and I think we'll probably request him to come for many more because it was wonderful talking to him. Abhay, great having you. Thanks for joining in.
Thank you so much, Neeraj. I always enjoy not only being on your show, it's the second time, but listening to your shows. I think the depth that you get into is really remarkable. So I look forward to being here. Thank you very much.
That's good. Well, we'll try and do the same thing today as well, Abhay. Can I start off with one overarching view and then kind of get into the details of a few things?
Sure.
So the overarching view, there's bad news all around, and everybody's spoken about the Russia-Ukraine conflict, supply chain snarls, and inflation and interest rates. Yesterday, the ECB did speak about taking the taps off, right, on the liquidity front. My larger view is that if the other things were to stabilize a little bit, which is the conflict maybe nears an end, or China truly opens up, or inflation shows some signs of peaking in the next 3 to 6 months if it does, but at the same time, the liquidity taps being turned off, how big an impact could that factor have? Because I don't think that is discussed as much.
No, I think that's very topical what you're asking, and I think for global investors that is the number one worry right now, because right now I don't think any of the global central bankers are thinking of the market impact. I think the market's impact has become secondary. I think what everybody is thinking about is that, look, how do we rein in this unbridled inflation? You're seeing US, Europe not used to inflation. In India, we are used to inflation, so it doesn't impact us so much. But you think of US, Europe, developed markets, seeing inflation, which they haven't seen in 40 years. The whole generation of Gen Z and millennials hasn't seen this kind of inflation. They're really struggling. And though there is wage price hike, but still it's not enough. And that's the reason we're seeing debt bubbles being built up, credit debt at its all-time peak in some of the developed markets. So clearly what has happened is that all central bankers have decided to go on the other extreme and say, look, number one agenda is to fight inflation. And simplistically, what the banks can do is to raise rates, take all the fiscal measures and then leave it to the government to do the non-fiscal measures. So from the bankers' perspective, I think we are in clearly for a regime where they are taking the simple way out of reducing liquidity and at the same time increasing rates to cut down on demand. So the view is that even if it is a supply-led inflation, nobody wants to discuss that. Everybody is saying that let's cool off the demand. Let us see if that brings down the inflation rates first. So the whole narrative has changed, and I think we are right in that narrative, and it is already having a detrimental impact on the markets, and it will continue to have a detrimental impact on markets because markets love liquidity, and if you take away liquidity, the markets struggle. So I mean that's what happens, and that is what is happening right now. So I don't see this changing in next 3 to 6 months for sure.
So suffice to say, Abhay, that you might be, while selectively looking for opportunities, are you sitting on higher cash than what you generally would? I don't know if you have a cash mandate per se. I'm still asking.
No, we don't have a cash mandate either way. What we tell our investors is that, look, give us money that you want to be allocated to equity at all times.
Okay.
But at the same time, while we as managers would like to believe that, look, and it has always worked out that longer term, you end up making money, you don't tweak your portfolios too much, you don't churn too much, don't let style drift come in. Those are very important hygiene factors. But I think these are extraordinary times. What we are seeing is a conclusive reversal of the liquidity cycle that started in 2008, and it's finally turning. And when it is turning, it is going to cause damage to a particular type of stocks, especially stocks that were bid up as high growth, so high multiple stocks. I think the leading investors in these stocks have taken a beating. In public domain, names like Tiger Global, SoftBank, ARK, and what that does is that reduces their ability to continue to plow capital into some of these high growth stories. So I think more than getting into cash, as managers, we are just holding our nose and saying that, look, we need to defend also, while long-term cycles will play out in our favor. In the short term, we also have to take without churning too much. So we are very, very critically looking at each company, each valuation, and removing or cutting down allocations to companies that are trading at a premium valuation. So because I think the valuations are already getting suppressed and will continue to go through correction. So higher the valuation multiple right now, those stocks will be at biggest risk over the next 3 to 6 months.
Okay, interesting. So purely based on numbers, Abhay, let me try and dwell into some of the Indian pieces. Purely based on numbers, we were looking at the last 3 years, last 5 years, the PE multiple expansion versus earnings expansion. And I may not have the entire bouquet with me, but I picked up 2 or 3 themes. Maybe start off with banking and BFSI per se, a theme which is kind of consistently delivered on earnings. Maybe rising rates augur well for them per se, and the valuation multiples don't seem egregious. Do you find favor in investing in the current times in BFSI? Why or why not?
And I think BFSI is the core for economic growth. If the economy has to grow even 7%, 7.2%, arguably 7 to 8%, that means the banking financial services sector has to pull its weight. However, what is happening now is that the peak NIM, net interest margin cycle has finished now. I think over the last couple of years post-COVID, the cost of borrowing, the cost of funds was artificially low for 2 years, and that allowed large banks to show NIMs of as much as 4%, which is it is ridiculous, frankly. If you ask me, that a bank, you're borrowing and lending and you're making a 4% net interest margin in this kind of environment, it's not going to sustain. So the net interest margins are definitely going to come off for even the best run banks. Secondly, there was under provisioning in the last quarter. We saw when we ran the numbers that if the provisioning was assuming that things post opening are going to go very well and a lot of assets will become regular assets. So I think there is under provisioning that happened last quarter that will reverse. And thirdly, I think in an environment where rates are rising, the credit costs for banks and NBFCs will go up because there will be delays as EMIs go up sharply. I'm not talking about the mortgage sector, that is steady, but in two-wheeler financing, in commercial vehicle financing, and unsecured loans especially, SME loans, we're going to see higher credit costs. And I don't think any of the bank's models are building in those higher credit costs. So my worry is that in banking and financial services space over next 2 quarters, there would be negative commentary combined with some negative surprises, no blowouts. So the valuations, I don't think, are still reflecting that, though the valuations have come off. So I personally do not believe that this is a space that will be looked at should be looked at as a defensive sector also over the next 2 quarters.
It's interesting you say that, Abhay, because the larger headlines all speak about how in a rising rate scenario, the lending rates will go up very quickly, the deposit rate won't, and therefore for an intermediate period of maybe 2, 3, 4 quarters as the case may be, there could actually be accrual to margins. And the most common narrative also spoken about is that the bank balance sheets are probably in the best shape that they have been in a really long time. And you are kind of countering both of those points.
Yeah, I am, because when you do a deep dive into some of the numbers, you see hotspots, you see two-wheeler loans, you see commercial vehicle loans, you see unsecured loans, SME loans not really provided for fully. And also, if we were not in, RBI was not in an inflation fighting environment, you could have argued that higher rates could lead to higher margins. But in this case, I can tell you, RBI is cutting rates because increasing rates because it wants banks to not make extraordinary profit, and the whole point is lost. So I think the RBI, the regulator, will be very cautious this time that the rate hikes are not leading to higher margin for banks, because then the whole purpose is defeated. I mean, RBI is going to watch it like a hawk, that what it is trying to do actually gets done. So I really doubt that the banks will get away this time by paying lower rates to savers and at the same time increasing lending rates. I really doubt RBI will let that happen. That's my view.
Okay. Fair call. Would be interesting to see this then, because the street seems to be unequivocally and unanimously kind of bullish on the banking side. So it'll be interesting to see that. The other space where I would love to understand what your thought process is technology, because here the division is very stark and the arguments for both sides are equally strong. So let me first try and understand whether you're bullish, whether you're bearish, or you're selectively bullish or selectively bearish on IT.
No, I think we are realists. At the end of the day, I think there is no point taking a very hard stance on each side. I think there are unique, specific opportunities in the space, and as long as we can identify those specific opportunities in the sector, I think that's good. I think there are bullish arguments overall. I would say that definitely worth looking at the space because of multiple tailwinds. You have lower attrition going into this quarter. We are already seeing that. So Infosys that had a 27% attrition, which is just amazing, and some of the other companies all struggled with 20+% attrition rates. TCS was the lowest, but still high. So attrition rates are coming down. That is one good sign. The second thing is that globally, the spend on tech has not stopped. There are still billion-dollar deals that are out there up for bidding because globally large banks, large companies are also trying to use tech to protect their margins, cut costs so that they can protect margins and bring in some deflation into the system. So I think tech as a next 5-year demand side, large tech, mid-cap tech should be okay. On the valuation side, my worry is that the sector as a whole is still trading at 20-25% premium to its historical average. So if you look at TCS, if you look at Infosys, TCS at 28 times forward is still higher, than its average of about 20 times multiple, or Infosys the same way, or some of the other leading names. So my worry would be that, look, if you are buying into large cap IT names, definitely go ahead because these guys will make money. But valuation is something that you have to be cognizant of, because despite this correction in IT pack, the valuations are still elevated compared to their historical averages.
Yeah. So if I took a look at the top 5 large cap IT names,
yeah.
TCS, Infi, and by the way, I don't want you to, I'm not asking you to make any recommendations. These are just views expressed. But if you look at TCS, Infosys, trading at multiples premium to HCL Tech, Wipro, Tech Mahindra, and I think those three are probably still trading in or around their long-term averages, so to say, maybe a few points here and there. But the last 10, 12, 15 years that I've seen, that's always remained the case. These guys never have kind of, even in its heydays when HCL Tech really showed good growth in organic plus organic, it never kind of narrowed the multiple gap too much. Yeah. So could it happen that these guys are available at good valuations, but maybe the valuations will stay that way for the other three?
I think it's the answer is in the margins, and one number that everyone looks at very closely is the EBIT margin. And when you look at TCS, Infosys, all 20+% margin consistently, and you look at some of these other names, HCL Tech, Wipro, Tech Mahindra, at middling teen kind of EBIT margins, that shows that, look, the kind of work that these guys are doing and the kind of deals that they're winning are very different. And also over last 3 or 4 years, size has become a big competitive advantage to in tech, because the deals that you get even invited to bid for, depends on size. So on one side globally now you have Capgemini, IBM, Accenture, TCS, and maybe Infosys creeping in there now into that big billion-dollar deal bracket. And then you have smaller companies one level below, and there are probably globally 70, 80 of them, maybe even 100. So the competitiveness increases there. And then below that is a free-for-all. So I think, for the companies to scale up, get to a size where they can bid for the real game-changing deals like TCS has very successfully done, frankly. That is what is, creating the differential in valuations right now. Because bigger you are, the more predictable your earnings are, the more predictable your growth is, and the more predictable your margins are. So I think investors are willing to pay a premium for that.
So then I'm confused. Are you saying that you are also preferring the same landscape, or are you saying that you want to buy value and therefore you will take selective bets in the ones which are maybe smaller but well valued?
So, we will always tend towards quality that way, as long as that we are not paying an outlandish valuation. So I think after the recent correction in the large cap IT also, we are seeing now valuations which were outlandish have come off. So in the current environment, even paying a premium, we will stay with the large cap IT names. And some of movement has been promising, like LTI's merger with Mindtree creates the fifth largest IT company in the country now, with pretty sustained high margin business. So I think there are some unique opportunities that investors can look at tactically in this space.
Interesting. My final question on this, I tend to dwell a bit on each sector, but my final question is on the ER&D space, wherein we now have maybe 3 or 4 companies, each one in that sense unique as well, with its own strengths, but each of them almost looking very heftily valued. I would use that term. So what's your sense on those names?
I think that's a great space, and that is a space which is a convergence of product and services. So it is always a very good place to be for companies, and I think there is clear demand growth there. But the valuation, as you rightly said, Neeraj, are kind of upfronting next 3 years returns probably. So we are also keeping an eye out in that space, but we haven't pulled the trigger. Maybe wait for something to come into appropriate valuation range of even 30 times multiple we would look at paying. But right now it's really far away from it.
Got it. Okay. In a similar breath, just want to focus on one more export-oriented opportunity, and which is pharma plus chemicals, but largely pharmaceuticals, right? Because we were talking to the Morgan Stanley analyst yesterday, and he was talking about how the second half of the year will see a bunch of launches across the US landscape from those players. And then there is the CDMO players, API players doing multiple things, diagnostics. So it's become a very wide bucket. How are you approaching it?
So I think the export space, which is the sizable space, the domestic industry is still quite small. But let's break it into the pharma export side. And we are seeing a sharp correction overall in valuations there also, again giving rise to very interesting opportunities, because at least it's a product that will be needed by the world, and pharma companies are exporters of deflation in that way. That if the Americans are looking at reducing costs of pharmaceutical, of the life sciences industry, healthcare industry, the pharmaceutical is a big part of that. So I think there will always be demand for different generics launched by Indian companies. The valuations have come off, which were trading at very significant premium in this correction. They have come off largely because right now the companies are dealing in such an uncertain environment that they are refusing to give forward guidance. Many of them, like Dr. Divi's recently, and the stock corrected. So I think there are opportunities in companies that are now trying to diversify their portfolio from simple plain vanilla generic exports to CDMO business, where it is more difficult to get the business, but at least it is much higher margin. So you get into 20 plus margin range in that business. So it's a new experiment, I would say, for Indian pharma companies to say that, look, how do we become more valuable? Let us get into business that is more difficult to get but more rewarding, rather than doing this plain vanilla generic export, which is opportunistic largely. So again, if investors can look at companies in that space that have done the capex and have done all the hard work, and now will probably gain from that. So I think the whole pharma space is giving very interesting opportunities for long-term value creation at the current level of valuations also. On the domestic side, I would say that hospitals remain a great opportunity. Demand will only go up as elective surgeries come into place. We are seeing average revenue per occupied bed go up. Last quarter, we saw that pretty much the average length of stay loss also increased for hospital sector as a whole, more for the leaders. So I think those are encouraging trends. On the diagnostic, it's a very, very competitive space. I think one of the diagnostics is probably the most competitive space across industries that we have seen. I mean, it's become a consumer product where you can literally launch with very low barrier to entry. So I think there is going to be a lot of pricing destruction there, which is already going on. Customers are spoiled for choices. So that is one space that we would like to stay away from for the time being till we see greater, some kind of pricing stability coming.
Yeah. So, I've been asking all my guests the same question about diagnostics, about the competitive intensity, especially after the intention from the Adani Group to look at that, and Tata 1mg, starting something that looked like a price war. The pushback that I got from some people, Abhay, and I would love to understand your views here, are that one, this space has a very long runway for growth because only 15 to 18% must be organized, the rest is unorganized. And a few of the people who are still constructive said that it can't be built overnight, it needs to be built brick by brick. There has to be a collection efficiency model, and therefore technology will not necessarily disrupt it, but only enable it. And the existing players, therefore, will, while the narrative may be bad, will stand to do better business and eventually will stand to gain over a period of time. How would you respond to that?
No, I think that's a good thesis. I would say that is not a flawed thesis. But there are some holes in it. Like what we did is what we were struggling was that we saw some of the leading chains doing very well in metros, in large metros, but not willing to expand into tier 2, forget tier 3, tier 4, tier 2 cities also. And then we said, what is the issue? Why are you not going there? And we didn't get good answers. So we commissioned a survey and we looked at 4 or 5 smaller cities, in Gujarat, Maharashtra, Madhya Pradesh, one in South, to understand what is the structure of diagnostic industry in these smaller cities. And we saw a remarkable price differentiation. Like the test that you would pay 200 rupees for in Mumbai, in this smaller markets, it would be 40 to 60 rupees. Wow. And then we started realizing that while optically you have the whole country as a market, the pricing is so different in these smaller cities that it is not attractive enough for the large chains to diversify there. And then the argument that technology cannot make a change actually works against them, because then you have to have a physical presence. But then if you have a physical presence with your cost structure, then how do you compete with the local labs that are doing blood sugar tests for 40 rupees or even lower, or the doctors commissioning it? And these are very standard tests. Look, blood sugar test costs, 4 or 5 rupees. At the end of the day, how much more can you charge? And I think that's why some of these big guys are coming in, looking at diagnostic as the thinner end of the wedge to build a larger healthcare business. Because once you have the diagnostics, you have the data, then you can start selling prescription medicines, and then you can do telemedicine, and then you can do, at some point of time, even hospital. So I think diagnostics is a space that is attracting the big guys into a zone, into a space that is already overcrowded, which is the metro space. And then there is the whole semi-urban, rural, tier 2, tier 3 space that is catered by a very fragmented bunch of mom and pop labs that work at very cheap prices. So I think the industry itself has to evolve a lot. And I think looking at it from that perspective of the industry structure, it is better to let it play out over a year or so and see how, who's winning that game.
Fantastic. Abhay, this was insightful. And it's great to know about the survey that you undertook as well in order to understand, because it gave us a new piece of information, at least something that I was not completely clued into. So thank you for that. But more importantly, thank you for sparing 25 minutes of your time today and talking to us with some really good insights.
No, thank you, Neeraj. It's my pleasure. And, as I say, I always enjoy your show. So thank you for having me.
The pleasure was ours. Viewers, thanks for tuning in.